Have you ever heard of a single flower bulb costing more than a house? No, I'm not kidding. This actually happened nearly 400 years ago in the Netherlands, during a period now famously known as Tulip Mania. It was the first recorded speculative bubble in history, and its story is a wild ride of obsession, greed, and a spectacular crash that holds powerful lessons for us even today. So, how did a simple flower cause such an economic frenzy? Let's dig in. Our story begins in the Dutch Golden Age of the 17th century. The Netherlands was a global superpower, a hub of trade, science, and art. Wealth was flowing into the country, and for the first time, ordinary merchants and craftsmen had disposable income. They wanted to show off their newfound status, and what better way than with something exotic and beautiful? Enter the tulip. Tulips weren't native to the Netherlands. They were originally imported from the Ottoman Empire, and their intense colors and elegant shapes were unlike anything the Dutch had ever seen. They were a luxury item, a status symbol. Owning rare tulips was like owning a designer watch or a luxury car today. The rarer the bulb, the higher the price. But what made some tulips so incredibly rare and valuable? It was a virus. A specific mosaic virus, unknowingly at the time, would infect the bulbs, causing the petals to break into stunning, flame-like patterns of multiple colors. These broken tulips were unpredictable and couldn't be mass-produced, making them the most sought-after of all. A single bulb of a rare variety, like the legendary Semper Augustus or the Viceroy, became the ultimate prize. As demand soared, prices started to climb, and then they skyrocketed. People saw their neighbors getting rich overnight simply by trading tulip bulbs. The fear of missing out, or FOMO as we call it today, took hold of the entire nation. It wasn't just the wealthy elite anymore, it was everyone. Weavers, blacksmiths, and farmers began liquidating their life savings, selling their homes, and trading their land, all to get in on the tulip action. The market became completely detached from the actual value of the flowers. It wasn't about gardening anymore. It was pure speculation. People were buying bulbs not to plant them, but with the sole intention of selling them to someone else for a higher price. This is a classic sign of a speculative bubble, when the price of an asset is driven by expectations of future price increases, not by its fundamental value. To make things even crazier, a futures market developed. Since bulbs could only be dug up and moved during certain times of the year, people started trading contracts for future delivery of the bulbs. They were essentially betting on the price of a flower that was still in the ground. These trades often happened in taverns, with contracts scribbled on scraps of paper over a beer. It was finance at its most frantic and informal. Imagine the scene: a bustling tavern in Amsterdam. A carpenter proudly announces he just traded his workshop for 3 rare bulbs. A sailor trades his life's wages for a single, promising-looking bulb. People weren't trading money for goods. They were trading real, tangible assets for the promise of a flower. At the peak of the mania in the winter of 1636 to 1637, some single tulip bulbs were reportedly sold for more than 10 times the annual income of a skilled craftsman. The price of one viceroy bulb was listed as equivalent to 2 loads of wheat, 4 loads of rye, 4 fat oxen, 8 fat swine, 12 fat sheep, 2 hogsheads of wine, 4 tons of beer, 2 tons of butter, 1,000 pounds of cheese, a complete bed, a suit of clothes, and a silver drinking cup, all for one bulb. It was absolute madness. But as with all bubbles, what goes up must come down. And the crash was as swift as the rise was meteoric. In February 1637, at a routine bulb auction in Harlem, something unprecedented happened. A buyer failed to show up. A wave of panic suddenly swept through the market. Confidence, the very fuel of the bubble, evaporated in an instant. Everyone rushed to sell at once. Prices plummeted. People who had been paper millionaires one day were bankrupt the next. Those who had traded their homes and businesses for bulbs were left with, well, just bulbs, which were now worth a fraction of what they had paid. The government tried to step in and mediate, but it was too late. The bubble had burst. Now, it's important to note that some modern historians argue the economic impact of the crash was catastrophic for the entire Dutch economy, as the legend suggests. It was more of a social and psychological shock, primarily affecting the newly rich and the merchant class, who were deep into the speculation. The Dutch Golden Age continued for many decades after, however. The story of Tulip Mania became a powerful cautionary tale that has echoed through the centuries. It was the first time the world witnessed the anatomy of a financial bubble, the introduction of a new exciting asset, the initial price rise that attracts early investors, the media hype and public frenzy that fuel mass participation, the speculative fever where prices detach from reality, and finally, the inevitable panic and crash. Does any of this sound familiar? Think about the dot-com bubble of the late 90s, where internet companies with no profits were valued at billions. Or the 2008 housing crisis, fueled by subprime mortgages and the belief that housing prices could only go up. Even in the world of cryptocurrencies and meme stocks, we see echoes of tulip manias, the same human emotions of greed, hope, and the fear of missing out driving markets to extreme highs and lows. So, what can we learn from a 400-year-old flower frenzy? First, understand what you're investing in. Is its value based on something real and fundamental, or is it purely based on the hope that someone else will pay more for it later? This is known as the greater fool theory, and it's a dangerous game to play. Second, be wary of herd mentality. Just because everyone is rushing to buy something doesn't mean it's a good idea. The pressure to conform and the fear of missing out can cloud our judgment and lead to disastrous financial decisions. And finally, diversity is key. The people who were ruined by Tulip Mania had often bet everything they owned on it. A well-diversified portfolio helps protect you from the collapse of any single asset. Tulip Mania is more than just a quirky historical anecdote. It's a timeless lesson in human psychology and the dynamics of markets. It shows how our collective emotions can create absurd situations and how quickly fortunes can be made and lost. The tulips themselves were beautiful, but the mania they inspired was a stark reminder that when greed and speculation take over, things can get ugly fast. Thank you so much for watching. I hope this journey back in time was as fascinating for you as it was for me. What are your thoughts on Tulip Mania? Do you see parallels in today's markets? Let me know in the comments below. And if you enjoyed this video and want to learn more about the wild world of finance and history, don't forget to like, subscribe, and hit that notification bell so you won't miss our next video. Until next time, stay curious and invest wisely.